George Selgin, welcome to Dad Saves America.
Oh, thanks for having me, John. I know it's going to be fun.
So I you are one of the people, maybe more than anyone else actually, maybe you and Larry White, who have informed what I think I understand about money, banking, and macroeconomics more than anyone else. And I think um, this is the area that you have devoted your life. You've written numerous books, perhaps the most provocative of which is Less Than Zero, which was a relatively small book that made at the time a very heretical claim, which is that deflation can be good if properly understood and in the right circumstances. And and you and Larry together helped to bring about what's known as the free banking movement. So, an alternative to the Fed, a look back at our history, and an understanding of what could a better monetary system look like than what we currently have, which produces booms and busts and inflations and macroeconomic problems. And so, um, I'm very excited for this conversation. And I have a couple things I want to try to get through, and I'm going to try to move quickly through some of them because people, I think, are not taught this stuff really at all. And the level of misunderstanding on the internet is vast. And I've made my own mistakes, even in recent videos, as you pointed out over a recent email exchange. So I want to start with essentially a basic, like foundational set of questions about money, banking, and macro. Like what are the basic principles at work? And then what does the Fed actually do, and what's its role in all of this? And then touch on some of the things that inform our dialogue as far as historical events like the Great Depression, the Great Inflation, and where we're at today. And then look to the future. What could a better future look like? And with all that, let's just start off with the most basic question of all. What is money?
That's an important question, John, because I find myself very frequently having to answer it. It is, according to economists, right? The word is used in other ways by the lay public, but according to economists, most of them, money refers to a generally accepted medium of exchange or means of payment. So that doesn't mean there's only one, but in any integrated economy, there will be usually at least one, typically one, generally accepted medium of exchange. And by that, I simply mean that chances are, if you walk into any store, for example, or rent a place from any landlord or engage in most other kinds of voluntary exchange, you will find that there is a certain type of stuff with a certain denomination. It might be dollars, it might be pounds, it might be euros, or in the past, it might be some metallic medium, or it might be tobacco, and so on, that almost all of those people will accept in trade. That's what makes something money. There are lots of things that are means or media of exchange, but not money, by which I mean you can buy things in some places with them. There are certainly trades you can make, but their acceptability is limited.
Give me an
It's
example of that.
well, Bitcoin is a good example now. It's probably the one that matters most because there's a lot of confusion about Bitcoin. In any place, almost any country you go to now, not every country, there are numbers of merchants and other traders who accept Bitcoin directly in payment, and they say so. But they tend to be a very small fraction of all the people who make who deal in money, who make uh, purchases, or who sell things, who rent apartments, etc. And so I would say that Bitcoin qualifies in many places as a medium of exchange, but not as money. And that can change, of course. It's not fixed in stone. but at present, I don't think it qualifies anywhere. Maybe in a few small places like Bitcoin Beach, it might qualify as money in those places, but they're few and far between. The cutoff, I should say, as should be obvious from my remarks, between a mere medium of exchange and money, a generally accepted one, is not hard. It's not a strictly defined cutoff. It's a very fuzzy line. And it's for that reason that economists, for example, when talking about the US money stock, they have about 5 or 6 different measures, depending on when, that are more or less strict when it comes to deciding what counts as generally accepted. So when I say Bitcoin isn't money in most places, I mean that it probably wouldn't make the cutoff for even the broadest definition in those places.
Okay, I'll keep this quick. Be sure to hit that like button, subscribe to the channel, and ring the bell so that you won't miss more Dad Saves America as our videos come out each week. And it also really helps us because when we reach out to guests, they look at how many subscribers there are to decide if they want to come on and share their ideas. So please subscribe to the channel. It really helps us out. And thanks for watching. Now, back to the show. The stock of money, or what, like, how do we know how much money there is? One question I sometimes come across on the internet is a distinction that some people will make between money and currency. So how should I understand the difference between money and currency and these other things that sort of get called money, like the different M's, M1, M2, MZM, all that stuff?
Yeah, that's a good question too. Usually, currency is used nowadays to refer to paper money, circulating money. So if you think of currency as circulating money, that is money that can pass from hand to hand without a bank having to be involved in the transaction, uh, that would qualify as currency. Coin is usually treated as a separate category of circulating money. So you often see currency and coin as an expression used. So that pretty much limits the term currency to paper circulating money. That is the most common use of that expression, at least today.
And then what about these broader, when we hear people talk about the money supply and sort of the Fed printing money, and we'll get to the Fed later in our conversation, but how should I understand what that is comprised of? Because it's not literally just the Fed. In fact, I don't think the Fed technically even prints the currency technically. I think it's the Treasury, right? But I mean, yeah, what is the full money supply?
So that's where we get into these different measures, John, to allow for the fuzziness of the concept of generally accepted. Currency and coin are included in all of them because they are the most generally accepted. Even those aren't generally accepted and aren't universally accepted. And it's important to note that more and more places don't like to deal with actual currency and coin. But in any event, those are included in most measures of money, certainly in all of the measures of money that are officially used here in the United States. But added to those, you have bank deposits, again, included in all the measures, most bank deposits. Some measures include savings deposits, but not include current account deposits, but not savings deposits. Broader measures even include time deposits, certificates of deposits, etc. And so the range of deposits that get included, that's what varies the most across these different measures of money. Another thing that can be included in some but not in others is balances in mutual money market mutual fund accounts. But what all these things have in common is that to some reasonably high degree, you can pay your bills with them. You can use them to go to write a check, or you can swipe a card to draw on them to pay for stuff. And that's what makes them qualify.
Now, how does that differ from my credit card? So I have my debit card in my pocket, which will draw the money right out of my checking account. But then I have my credit card, which to me as a consumer works the same way. I go to the store, swipe my credit card, money comes out. It's there available to me right there on demand. So what's the difference between those two?
With a credit card, you're not actually paying with your own money. You're borrowing from the credit card company. And you'll know the difference because you get charged for that. And the credit card company pays your bills until and then it sends you a bill in effect. And that's when you pay off your card, which you may do completely, or you may continue to rely on the company's credit and thereby avoid paying right away at the price of having to pay more interest. So a credit card is really just a device for having another entity pay for something until you pay it back with interest.
The I'm going to come back to these distinctions when we talk about inflation, but to stay on this question of what money is. There's a concept that I hear thrown around on the internet. There's obviously I am among the internet wannabe economists myself, so I am guilty of all these things. People get very excited about this issue, about money, about what money is, about what we should do with money. I've done a bunch of videos about modern monetary theory, and it brings all kinds of characters out of the woodwork into the comments section. One of the common things I hear, and this is across ideological lines too, this won't just be like sort of left-wingers that want to print infinite money to pay for things, is the notion that money is debt. And a lot of times they'll talk about money in a broader sense of well, we have a debt-based monetary system and therefore we need infinite growth to pay off the debt, and it's a never-ending spiral of money and debt. Are you familiar with this language?
Yes,
And help me
yeah.
disentangle this.
Well, disentangle is the right approach because you mentioned at least two distinct issues. One is issues or claims that raise questions. One question is money debt, or to what? How is it tied up with debt? And the other one is, if it's tied up with debt, does that mean we have to grow or continually, or et cetera, et cetera? So, on the first question, money and debt tend to be, but aren't always, closely married phenomenon. And that's because most of the money we use today, certainly the money that consists of bank deposits of various kinds and mutual fund balances, is 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 backed by various kinds of investments. And so, from the bank's point of view, uh, it it owes that money to us, so that makes the money a debt to it, right? And of course, its creditors owe the bank, and so that is very much involved in modern money, and that's been true for a long, long time. The reason is that it's convenient and it's actually very economically beneficial. Adam Smith wrote about this quite eloquently, by the way, so it's been going on for a long time, even though it's also modern. To use as money the IOUs banks create, whether they're deposits or in the old days, they might be the bank's own paper circulating currency. It's very convenient, can be very convenient. And what that does is to allow us to have a medium of exchange that we're holding that at the same time is an investment. Namely, we have placed our savings with banks that can in turn invest those savings by lending them to various borrowers. And that's a very efficient system and can contribute a lot to economic growth, as compared, most obviously, as compared to a system where we all go around with a bunch of gold coins, clinking in our pockets. In that case, if that's all we use as money, then in a way we're investing in the gold mining industry, but we're not making investment of a broader sort possible. So what Smith writes, and it's in the book 2, chapter 2 of The Wealth of Nations, and it's as great as when it was first written for understanding this basic idea. He said, well, that's like the difference between having a cornfield where you have to have a road through the cornfield to gather the corn. So you miss out on that much more crop versus having a cornfield where you can harvest it by flying over it and sucking up all the corn so you can plant that many more acres. He said, if we use bank-based money instead of gold, then we have more productive resources. We still have a medium of exchange, but it is a medium of exchange that doesn't take up our investment opportunities in the same way as bank issued substitutes. If we could use bank money instead of gold, I should say, we have a medium of exchange that doesn't take up scarce resources the way gold itself does. It allows us to be investing at the same time as we give ourselves money balances. So that's nice.
So to make sure I'm understanding correctly and put myself in the shoes of the first time listener for these concepts, I get my paycheck.
Mm-hmm.
Let's say they pay me cash, so I got currency in my hand.
Yeah.
And I can keep it in my pocket, and that's savings until I spend it or put it in a safe or in a safety deposit
That's right.
box, which it's
That's
sitting
right.
there, and there it is physically. I can go and I can check the serial numbers, or I can put it in a savings account at which and the point at which I put it in the savings account with my bank, I'm technically lending it to the bank. Is that
Yes, and
right?
that would be true. Yes, and it's important to stress you would be lending it if you put it in a checking account as well. The checking account gives you more flexibility on when you can take it back, ask for it back. But while it's there, it's lent to the bank. And go back to the gold example for a moment. With the gold case, if you hold gold coins, the only investing you're encouraging is in the gold mining industry. You're buying gold. And that, of course, is giving resources to the gold mining industry. And that's fine for the gold mining industry, but doesn't help any other industry. Whereas when you take a bank's IOU, the bank would hold some gold reserves, but mostly it would back that IOU with other kinds of loans. And so would support more broadly both industry and consumer borrowing and that sort of thing. Today, if you take your paycheck in the form of Federal Reserve notes and stuff them in a safety deposit box, you are making an investment, but it's very limited. You're investing in the Federal Reserve, and whatever the Federal Reserve invests in, which is mostly U.S. government securities. So that shunts all the savings that are represented by paper currency toward the government. In the same way that holding gold coin once upon a time shunted savings toward the gold mining industry. Neither of those is the most productive way savings can be used. There are other opportunities. What banks can do by issuing their IOUs in place of either Federal Reserve notes or gold is to give themselves the opportunity to look around and apply your savings to whatever outlet offers the best return, risk adjusted, of course. And chances are that less constrained set of alternatives includes things that are going to ultimately help the economy grow more. And Adam Smith's point was we got more economic growth. He was talking about Scotland because we used these bank issued IOUs than we would have had otherwise. And he stressed, and later economic historians have shown, that it really made a big difference for Scotland's economic development over time.
Yeah, I understand you've written about the Scottish Enlightenment, of which Adam Smith was a part, and sort of the role that sort of Scotland played in essentially like training and giving rise to bankers coming out of
Yeah,
Scotland, right?
that's true. Well, that's particularly relevant for Canada because Scotland and Canada are have two of the most interesting historical banking systems. They're still interesting today, but they ain't what they used to be. But both of them in their day, which includes most of the 19th century, were by common understanding among the most efficient, well, if not the most efficient and relatively stable banking systems in the world. And they weathered crises a lot better than their southern counterparts, the U.S. banking system and the English banking system. And so people were interested in understanding why. But part of what was true about these systems was that in many ways they were they were not completely unregulated, but they were regulated in a rather uh, generous way. There was not as much interference with banking freedom as there was in the US or in England. The US didn't have a central bank during the 19th century, so it didn't interfere with banking freedom that way, but it interfered with it in all sorts of other ways we could go into if we have time. In England, the main interferences consisted first of the monopoly privileges given to the Bank of England, and also related to that, the fact that for most of the 19th century, all other banks in England were confined to having six partners or less. They couldn't even be corporations. So they were small and under-diversified. Our banks in the US back then were under-diversified and small for a different reason. We mostly prohibited branch banking. So you had very weak banks compared to Canada and Scotland, which had smaller numbers of strong, diversified banks. That was
I,
part of their success.
I want to come back to this fact and this different institutions when we a little bit later, because to the extent we as a public hear about banking at all, it is almost entirely through the lens of the failures of the Great Depression. And you've
Mm.
written about this at length, and the different outcomes in places like Canada. And your writing about that taught me a lot about how much we are how much misinformation our school system imparts to us. Uh,
Yes, well, I'm afraid this is one area where the economists are quite guilty. Of course, there are good ones. If you read the economic historians, that is, people who specialize in knowing what went on back then, you'll get a pretty good account of the real causes of the bank failures to the Great Depression in the United States, for example. And you'll also find articles about Canada and how it fared differently. But other economists who don't specialize in that history often don't resist assuming that they know it and mouthing off about it. And when they do, it's almost always wrong. So that's where a lot of misinformation comes from.
I want to dig into what banking is more, but the last question about money itself I have is who invented money? Because there's a lot of writing, often from the left. I think David Graeber might be one of them, like Debt, the First 5,000 Years. I might be
Yeah.
misremembering his name. God rest his soul. I know he's passed. Um,
Mm.
Talk about the role of the state as being the ultimate creator of money. That money is a creation of the state. But is that the
Yeah.
case?
No, I don't think so. Let's be clear. no one knows exactly who invented money, and of course, it wasn't just an invention in one place that spread around. I think I think uh, David Graeber would agree that money occurred independently in many different places. Uh, so it certainly wasn't invented by any one person. But as for the role of the state, uh, we don't know who produced the first coins. Uh, Certainly, there were types of money in use that weren't coin, consisting of other kinds of commodities like cowrie shells, for example. Uh, and we
You
have no
mentioned
re
tobacco.
Tobacco was later on, that's right. But in the case of take the cowrie shells, which were used fairly widely as currency, salt is another thing that comes to mind. These are naturally occurring. So, for one thing, there was no inventing as far as inventing the actual stuff. It was a matter of using the stuff differently than it had been used before, using it for a different purpose, for exchange. Uh, and uh, and of course, it wasn't just a matter of being willing to offer it; it was a matter of people's willingness to accept it, which depended as much as anything on how much they coveted the stuff. You know, you didn't need an inventor; you just needed the fact that people liked these things. Often there was there's clearly a close connection historically between early monies and ornament. Right?
Hmm.
If you think of jewelry, you can see that connection.
Yeah,
Uh,
gold and
many
silver.
types, many types of so-called primitive monies were worn in some way. Then you just hand off some of them, the stuff, and so they were prized as a commodity for uh, for looks, if you like, but also useful to make payments. The earliest coins were the electrum coins struck in Lydia and Asia Minor. And there continues to be a debate among numismatists about whether some of them were private or not. We know some of these coins, the earliest that are known, had the markings of princes and kings. But we also know that many didn't. The markings seem to not have any relation to any rulers. And at least some numismatists, prominent ones, not just on a fringe of the specialty, uh, believe that they were issued by private parties. Now, it gets very confusing, John, because in those days the distinction between private and public wasn't as clear as it is today. A very, very wealthy person was likely to be politically powerful one way or the other. There wasn't the strict understanding of the state that distinguished it from the people that we have today. Uh,
Well,
uh, yeah, well,
the
it's
distinctions today
well,
are getting a little
yes,
shaky.
yes, but, but they have the guns and we don't, for the most part. And in those days, church authorities too, were they government? In many ways, they were in many places. So it's not always easy, even if you could know who struck a coin, to say, ah, that's government and that's
Right.
private. So it's very, very difficult. I think, though, it's important to distinguish between two questions. One is who made the earliest monies, who actually issued them, and as I've suggested, there's quite a veil drawn over that history or prehistory. Uh, and then from the question, can money be produced, issued, and even made very efficient without the state? And my
Yeah.
research has mostly been about addressing that second question, not the historical question, but the question whether money can be a private good and whether it can be produced effectively and safely by the private sector. and it's there that I've tried to uh, move the pendulum away from the conventional wisdom that, oh no, you can't possibly have money that's any good that's not produced by government.
Yeah, and this is your book, Good Money, goes into this in no small measure.
Good money is one of my efforts to one of my research projects that is meant to cast doubt on the conventional wisdom, specifically there with respect to coin making.
So one of the last pieces, there's two other pieces of the puzzle that I think are important for people to grapple with when thinking about money. Well, maybe three. Uh, so one is, um, does any money or anything for that matter have what people will often say intrinsic value? So a lot of times people will say, look, I think only gold is real money because it has intrinsic value, whereas paper money like Federal Reserve notes, that's just paper, that's not worth anything, but gold has intrinsic value. So how do you understand this concept of intrinsic value and its relationship to the value of the money people use?
I think there is an important distinction between monies that have no use, non-monetary use value, and monies that also have non-monetary use value. I don't think speaking of intrinsic value is very helpful here. And the reason is intrinsic value connotes something, a value that is in the good itself and not a product of human valuation. That is, that's there, even if we all drop dead, these things would still have intrinsic value. Well, nothing has intrinsic value in that sense. All values, and most economists would agree to this, all values are imputed values, or values that we as human beings assign to different goods and services. But there is a distinction between use value and exchange value. Uh, a simple case, gold coins, or gold generally, right? Gold is not money anywhere today. Uh, it used to be widely used as money. It isn't money now, and yet gold is extremely valuable. Why? Well, it has uses other than as money. Uh, Jewelry is obvious, but they're filling cavities is another one. There used to be, and other industrial uses. And Of course, gold is demanded as a hedge against inflation today, which is strictly speaking not a demand that's a medium of exchange demand. It's a different kind of investment demand. So gold has use, non-monetary use value. That isn't true, or it isn't, it's assumed not to be true of something like Federal Reserve notes.
Oh, you can burn them for warmth.
Yes, you can burn them for war. We can talk about toilet paper and wallpaper and papering your walls and
Zimbabwe style,
that.
Weimar style.
But let us say that these uses are more desperate than anything else. For the most part, uh, Federal Reserve notes owe their value strictly to their being useful as means of exchange. And that goes for dollars today, fiat dollars. Generally, their value is as a medium of exchange. Uh, and That means, of course, that if they ceased for any reason to be useful as means of exchange, they would be, well, valued for their combustibility.
So, is
As
that
you,
a good way to think about when we have seen hyperinflations in the past, whether it's in Zimbabwe or the Weimar Republic or modern Venezuela, that basically the trust in the continued value of the money collapses, and with it the value
as
itself?
right, these are monies that lost their appeal as monies, as exchange medium. Uh, Now, it wasn't just the demand side, mind you. Most
Right.
hyperinflations, are started by and aggravated by uh, usually ultimately very substantial increases in the nominal quantity and the number of units created. But at the same time, in hyperinflations, you have a loss of confidence, ultimately eroding the value of the money even more. Basically, people decide it's not a useful medium of exchange. It's not reliable. They'd rather not hold on to it at all, which you can't avoid holding on to something that you're using as money. But if people decide they don't want to have anything to do with it, they won't do that. You don't have a gold hyperinflation. You couldn't have a gold money hyperinflation because if worse comes to worse, it ceases to have non-monetary value, but falls back on the various other uses that it can be applied to. So hyperinflation is almost always is a phenomenon that is only associated with monies that don't have any underlying non-monetary use. And Bitcoin, by the way, is another example of a money, or aspiring money, I should say, a would-be money, potential money that does not have any non-monetary use. So that doesn't mean that its value today isn't largely speculative. It's not being used as a medium of exchange that much, but its fundamental use value is as a potential medium of exchange, and particularly as a medium of exchange where pseudonymity is desirable as a means of transferring wealth under the radar of snooping officials and that sort of thing. But in any event, there's no non-monetary use value in the usual sense of the term.
Why has and this is a leading question, but why do certain types of products historically become money, and particularly gold? Because gold, and to I think a lesser extent silver, but precious metals, especially gold, historically prior to the rise of all these central banks and all this government fiat money, became very broadly used around the world. Why? What are the like qualities of these certain commodities like gold or tobacco that make it useful for money, and not, or even like uh, cigarettes inside of a prison, for example, versus other things?
Well, you get into this textbook list of uh, homogeneity, fungibility, storability, and all that. For the really early monies, not the precious metals, the fact that the fact commodities that were fairly uniform naturally occurred in roughly uniform units, like those cowrie shells, and that were familiar in other ways. So it was relatively easy to look at them and say, well, this is a good leaf of tobacco with a value we kind of know. You needed that. You needed something that was recognizable. You could ascertain the value relatively easily, or the quality. You could, if you had to, you could weigh it. But there
You
were
could bite
low
it.
costs. You'd buy it. The low costs of ascertaining what it was, and it helped if it was divisible, if it wasn't already in nice small units. The precious metals caught on partly as a result of economic growth. When it was designed, when transactions became greater value, transactions became more and more important. You wanted to have coins that weren't gigantic. You didn't want to have to haul around copper coins, as they did do in China, for example. But it got to be quite a pain. So there was a tendency for the more precious metals to become more important as economic prosperity increased. They raised issues, of course, because they didn't occur in natural units. So you had to make them practical, you had to develop minting technology, minting techniques that would produce units of uh, reliable weight and fineness. And that was never easy. And as I wrote about in Good Money, the book you mentioned, governments were not particularly good at it, despite conventional wisdom that says otherwise.
Yeah, I think it's easy to forget this that but you can still see remnants of it with a quarter with like a quarter. You got these little lines around the side, right? What were those lines originally for?
They call them milled edges. The problem was that with precious metal coins, if they would tend the whole idea was that the coin was supposed to be a reliable indication of the quantity of gold, right? Both the quality and the quantity. But right now, that's the quantity or weight that's relevant. And so the problem was that if the edges of the coin weren't marked somehow, that it was relatively easy for people to shave off some of those edges. You'd still have a coin that looked round. It might not be obvious that it's a little smaller. And of course, they by doing that to a lot of coins, they could come up with a lot of raw gold and make some more coins with them. So that would be the profit. So they did
Clipping coins. Is that what that this was
clipping
called?
coins. That's right. And they also would put them in a bag and shake them and collect the dust. There were a lot of things that could be done to impair the coins and ultimately erode their true worth. Milled edges were an innovation that was designed to prevent that. It would certainly make it a lot harder to mm, uh, take some of the gold out of the coin without people realizing it had been done. And this was a technology that was actually developed quite some time ago, but it tended to be used only on the more valuable coins. And the less valuable coins, governments were tended to be very, very shoddy in their production of those coins. Unfortunately, those coins often needed it most because, especially if they were token coins, their value didn't depend on the metal in them, but it depended on not being able to fake them. And those coins were often so badly made that it was easy to make fakes that looked as bad as the real one.
So the before we sort of move on to a little bit closer look at banking, there is this. It's almost a metaphysical idea. It's certainly an idea inside of Marx and sort of far left progressive philosophy. The notion that we should, but you can maybe even say it's a kind, it almost sounds biblical, that we would be better off if we didn't have money. Money is the
Yeah.
root of all evil. That an economy without a medium of exchange would somehow be more fair and more just and more humane and have greater social justice. Um, that this technology that has been discovered and all around the world has some corrupting soul in it, and that we
Mhm.
have to move towards other things. I've heard terms like we need a resource based economy, whatever that's supposed to mean, or all manner of not money economy claims. So how do you understand what is being said there, and like what is the value of money for human well-being as the tool that it is?
So, yeah, you're right. This view exists out there. You find it especially among anthropologists like Graeber and also science fiction writers. Most of the utopias that they come up with are moneyless. It's a
Yeah, like
very
Star
common
Trek.
assumption. Yes, it's very common. Um, and there's a core of, I won't say a core of truth, but there's something to the argument that makes it possible to understand where its proponents are coming from. To focus on the anthropological and what Graeber and other anthropologists have pointed out is that before there was monetary exchange within village communities, tight-knit village communities, you had what's sometimes called gift exchange, though it's an oxymoron. It's not gift exchange, it's people, you do something for me or give me something, and I might or might not reciprocate later on, but I do reciprocate later on because there's a implicit understanding that we're all supposed to help each other out. Uh, this kind of gift giving, to call it that, reciprocal gift giving, goes on in today in modern societies to a very limited extent within families,
Mm-hmm.
right? You, Johnny takes out the garbage and Susie washes the dishes and Susie gets a place to sleep and Johnny gets dinner. That sort of thing happens all the time in families. Well, a lot of these villages were like extended families, a lot of these early societies. So that comes first. There's no money. It's a kind of credit arrangement. And this is what the anthropologists mean when they say credit, and it comes before money, because in a sense, it's a credit arrangement, right? I just fed you, you
Yeah.
owe me taking out the garbage, right?
Right.
That's a credit exchange. It's unwritten. Okay. Now, here's the thing. All that is well and good within these, call them tribal units,
Yeah.
primitive, tight-knit community. Um, but when you get outside of that community, when you talk about the interaction of the next tribe with your tribe, things get a little dicey because the possibility of reciprocal gift giving isn't really there. There's not enough interaction. There's not enough scope for sanctions, etc. More likely, if the tribe next to yours decides you have some things they'd like, they'll raid you and pillage you. And so, among different tribes, the alternative to monetary exchange is perhaps more likely to be warfare or just being victimized than lovey-dovey reciprocal gift giving. Money emerged, and Graeber himself admits this. Where he goes wrong is in denying that economists know it. Graeber himself says in his books, first he says economists are all wet because they think money emerged from barter among people instead of there having been any reciprocal gift giving. Then he says, of course, among strangers, that kind of thing can have happened. Well, that's all the economist's story is, implicitly a story about strangers, how they developed money by first trying to barter and then finding that some things were much more easy to barter with than others. And in fact, it's not even just implicit. If you read Carl Menger, whose work on the evolution of money is the most important in all of economics, in his longer study of money, not the short article that's been somewhat badly translated into English long ago, he explicitly talks about gift societies and gift giving and all that as antecedents to the kind of exchange that led to the innovation of money. It's very explicit. And by the way, it was explicit before the great anthropological studies of gift economies were published. Pixilla was talking about, Menger was talking about them before. So anyway, where Graeber goes wrong is in misstating or misunderstanding what the best economists have had to say about this, which isn't so different from what he says. But to get back to the original question, right? The people who say money's the root of all evil and that we'd be better off without it, and imagine that could be better off without it, are really thinking in terms of the big family or little village model of existence and not how we can all get along in a world where there are, like it or not, lots of tribes, and what are our options for interacting as tribes, and where there isn't going to be repeated interaction all the time. There isn't a basis in, for subtle sanctions and all that. And that's when you start getting the choice starts looking more like bloodshed versus barter. And then ultimately it starts looking like bloodshed versus monetary exchange. And contracts start getting written and everything becomes explicit. And we develop the commercial society, right? The commercial
Yeah.
society isn't a substitute for, it wasn't meant to be, it didn't originate as a substitute for being friendly. It originated as a substitute for being killed or killing the other person. The Now here's the thing. As the commercial society and the monetary society developed, they start making inroads into the community. Why? Because now that you have more opportunities to trade with strangers, you can specialize in your production. We can take advantage of the division of labor. So the next thing you know, you're not trying to produce a lot of things in your village. You're producing a few things and trading. That means monetary exchange takes over and it reduces the scope of friendly gift giving. And that becomes less and less important. And so your society isn't so cute anymore. Uh, it's wealthier. It can be immensely wealthier, but for better or for worse, those reciprocal gifting relationships uh, that make made early villages look like big families. Not necessarily happy families, but at least like big families. Those go away. Those become less important. And all it takes is a little romanticization of those early communities to make people nostalgic and think, well, this is an awful development.
So one of the things that I think is interesting to think about, and I think is why this sort of romance about this tight knit community life that money and sort of a commercial monetary society intrudes on and crowds out is a way you're it's I think a fair way to put it.
Yes, that is what happens.
And
That starts with building more bridges with the strangers, but ends up, as it were, eroding some of the informal relationships that were the basis for the local community. And it's difficult to have those things just tend naturally to go together. And Adam Smith talked about this too. So did Menger. They all recognized it. It's a price you pay for living in a world, a commercial world, as opposed to a world of isolated and occasionally warring tribes.
I think what's hard today is the breakdowns of the family and local communities to the extent they've happened, which I think they have, has given rise to a lot of loneliness and isolation and mental health decline that I think is causing the cost benefit analysis for some people as far as commercial society to not look quite so great as it used to look. It's like, well, maybe
Written
we'd be
about.
better off. Maybe we'd be better off being a little more close knit, even at the expense of some things. I think the would we really be better off? Probably not, because getting murdered by a warring tribe sucks worse than being alone in your mom's house. But I don't want to minimize the feeling of being alone in your mom's house. Um,
No, that's right. No, I think that there is such a thing as tragedy. That's where there's no perfect or entirely satisfying solution. And like I said, here the commercialization is building bridges with the strangers and trying to substitute peaceful relations with strangers based on uh, voluntary exchange. Uh, that that unfortunately tends to result in a backflow, as it were, of the same commercial uh, tendencies into the smaller communities and tribes themselves. And the next thing you know, they're more strangers to one another than they used to be, though
Mm-hmm.
they're less strangers with the rest of the world. And I don't know how you get to have the one improvement without the other downside. I don't know
Yeah.
how that could happen. But that is basically the story. Helps, I think it's important to understand, as you do, where people are coming from who bemoan the ill consequences of commercialization. Uh, but but it's also important to not over romanticize the life among these life in these village communities. It's very easy to assume that it was uh, just all friendly, happy people.
Yeah. Sort
First
of
of all,
utopian Rousseau,
yeah,
balance of nature as opposed to sort
besides
of brutal and short.
besides being raided by your neighbors, uh, you had the short life expectancy. Disease was a problem. Uh, Agriculture, if it existed, could be very unreliable. Uh, there, uh, the ability to trade with others does diversify your options at the same time as it leads to specialization at home. I think that most people would not, if they could give it some thought, would not want to switch uh, their lives, uh, modern Western commercial existences with all the innate alienation that entails would not be wise to trade that for life in most of the gift societies that anthropologists have written about. But maybe I'm wrong. Maybe other people would feel differently.
It's yeah, we're not good at um thinking about things in gradients and grays. It tends to be that we snap into a binary, so it's hey, there's elements of the older more communal society that we should try to preserve while also having the benefits of modern division of labor and the
Mm-hmm.
kind of global cooperation that gives rise to this Zoom call being possible,
Right.
which keeps us connected, and that's a kind of community thing that's impossible in the gift society. But instead,
There's
we end up with a dialogue that's like, well, we should either be radical individualists or we should be local communists, and everything in between is not even something we can talk about.
yeah. No, a lot depends on the value one attaches to the possibility of being a world citizen and of being able to enjoy what an entire planet has to offer, uh, as opposed to being satisfied with one's lot in whatever community one happens to be born in. And these are huge questions, of course, but um, I dare say most of the people that write about how idyllic these small villages are don't live where they grew up
Yeah, right.
and
Yeah,
wouldn't want. That's
they're in the French salons of Paris and New York
right.
and
Yeah. So,
societies that would collapse within a week if money and power were pulled out of the wall. Um,
something like that.
okay, so banking. We've touched on this a little bit now. Um, this is where there's interesting, if perhaps slightly off in the corner of the internet debates taking place to this day quite vociferously. So you wrote a paper recently that our mutual friend Scott Sumner pointed to and said it's sort of a travesty that George even needs to write this paper, saying that yes, banks are uh, um, well, intermediaries for loanable funds. So
Hmm.
so what is a bank really? We've already talked about this, but let's hone in on it. What does a bank do Why does it charge interest for what it does? What is the human value of the service a bank provides?
Well, the position I defend in that paper is one that holds that banks are intermediaries. What's that? An intermediary is a go-between, a middleman. And banks are intermediaries in the sense that I described earlier when I was talking about Adam Smith, in that they borrow from ordinary folk, people who keep deposits with them, and in turn, they take advantage of their borrowings to fund loans that they make, business loans, mortgage loans, consumer loans. And they do charge interest for those loans, and they profit from the difference between what they earn on those loans, on the interest, and what it costs them in interest or in other factors and other expenses to maintain the deposits that they keep. And so that's the view I defend. Uh, it's an old-fashioned view. The view I'm criticizing is also old-fashioned, and old-fashioned in that you can find subscribers to it going a ways back. But I'm particularly going after a paper written, a working paper put out by the Bank of England, which claims that banks aren't intermediaries. Their lending doesn't depend on their borrowing from others. They fund their loans simply by taking advantage of their ability to create deposits, which they do. And so, since banks can create money, they can create deposits, uh, they don't need to borrow from anyone in order to lend to people. They can just have a borrower come up to them, offer them what appears to be an attractive interest rate, and they say, fine. They write up the loan. They basically create a deposit balance. That's the money creation. And that is also the credited to the account of the borrower. So that's the loan. So they don't need to borrow from anyone. Now, as I point out in the article, uh, this is a nice story, but it doesn't trace out the consequences of the creation of that balance. And you have to take those into account and follow the money, as it were,
So I
in
want to
order
follow that,
to
but
realize that the bank, yeah, has to actually end up having resources other than its own money creating power.
so I it's hard to understand that other story, but to I want to for those who are this is often hard to follow. So to sort of re-summarize your view of the bank as intermediary, I always think of the movie, which most people will still see because it replays every Christmas. It's a Wonderful Life, right? And
Mhm.
so you have Bailey, who is faced with this dilemma. It's the Depression, and there's a run on his bank, and the people in his neighborhood come and they want their deposits out of Bailey's bank. And he says, well, I can't give you your money because it's in your house and in your house and in your house. Like that, he's sort of illustrating, like, oh, you lent me the money, I lent it to your neighbor to buy their house. So
That's right.
I don't have your money right now. I will over time, but I don't have it right now. Um,
Yes,
so that's a kind of tangible. You could watch it in the movies depiction of what you understand banks to do, right?
that's right. And by the way, that bank is not a bank, it's a building and loan. They were called building and loan societies. And the those deposits weren't demand deposits. So the bank wasn't actually Bailey's bank wasn't obliged to give the people their money right away just because they asked for it. Um, but in any event, he is describing an intermediary. He's describing a bank that borrows from its customers and then invests by lending to others.
So now you have this alternative view there's a guy by the name of Steve Keen who is sometimes recommended to me to talk to, as who's a critic of yours on this, who takes the other
Yes, I've
side.
been on his show too. Yeah.
so so walk me through what Steve Keen and his cohort are claiming. You just did, but I'm not even sure I fully understood what it meant. So how can what exactly is happening that the bank creates money out of thin air? I see this in my comments every time I talk about money in banking. People say, "No, that's not what happens. Banks create money out of thin air."
So, first of all, let's be clear. Banks creating money for a bank is easy. It doesn't take any resources to create money, but it does take resources to fund a loan. Now, what do I mean by that distinction? As I said, if you walk into a bank, then let me be the bank. You walk
Okay.
into my bank and you want a loan. Let's say you want 50 grand to buy yourself a new car. And I can costlessly write you an account. I can costlessly credit you an account. I give you a bunch of blank checks or a debit card or both. And hey, presto, you have this credit in your new account, 50,000. There it is. That's easy. That's just, that's a bookkeeping entry. In that sense, right? Yes, banks can create, because that money, that would count as part of the money measure of the United States. By creating that checking account balance, instantly increase the US money supply by 50 grand. Okay?
Okay.
That's easy. That's easy. The question is, can I get away with it? I mean, I can do it, right? And I can do it didn't cost me a nickel, a little bit of bookkeeping. The question is, can I get away with it? Well, no, not if I didn't have any resources to begin with. So let's say I had nothing, right? I've just opened my bank. Hey, I'm banking. Let's say I have nothing. Now, what do you do with the 50 grand? What do you do with that money? You go buy a car.
Right.
You're not borrowing it. I'm charging you interest, by the way. You're not going to leave it. You're going to buy the car. That's the whole point. You had a car, cost 50,000. You took out a loan. So you go to the car seller and you write him a check. Let's be old fashioned because checks are a little more tangible. But you could swipe a debit card, wouldn't make any difference. And you're the guy who sells you the car. He takes the check to his bank. His bank sends the check back to my bank to be paid. So I can hold on. Now I've got to settle with his bank. My bank has to settle with his bank. I can't I can't say I could try to say to his banker, oh hey, you know, how would you like an account in my bank in lieu of any other payment? No, I'm a bank myself. I don't need an account at your bank. I'll take cash. I'll take Federal Reserve dollars. I can use them for stuff. I don't need to be your customer. Now I've got to come up with those 50,000, not in my own created out of thin air, resources. I've got to come up with $50,000 in reserve money to transfer. And and only the Federal Reserve can create those reserve balances. So either I had them on hand before, or I've got to scrounge for them. I've got to borrow, or I default. One way or the other, it turns out that my capacity to lend you 50,000 depends on my funding the 50,000 with resources other than ones I can create out of thin air. So it's by tracing the consequences of lending that one can arrive at the understanding that after all, banks' money creating powers alone don't suffice to sustain their lending. They ultimately do have to borrow in order to lend, and that makes them intermediaries.
So in the world of heterodox internet thinkers that we all come across, this claim that you're saying is true but in this short, narrow, limited way that, oh, I go to the bank, they lend me the money, and for this brief window before I can use the money for the thing I'm borrowing, it appears as an accounting entry.
And nothing more. That's right.
Why does Steve Keen and people like him, and I'd like to talk to Steve Keen about this too, but you've been on his show, so I'm gonna, and I know you're an honest dealer of ideas. What is the point he's trying to make about that? Like, why is that contentious? Why do my internet
Well,
commenters say, aha, you don't understand the way banks work?
I can't comment on motive, uh, but I do think that the that one of the consequences of the way they're arguing is to suggest that, practically speaking, there's no difference between ordinary banks and central banks, that they have the same powers, and that once we realize that most of the money we use is commercial bank money deposits, then the fact that they have similar powers suggests that it's really the commercial bankers that are responsible for the rights and wrongs of American of monetary policy. If we have too much money creation, and it's not particularly the Fed's fault in the United States, it's the commercial bank's fault. So what their arguments do is to diminish the role of central banks, diminish their responsibility for excessive or deficient money creation, and suggests instead that the machinations of commercial bankers are really what's driving things. And I think that is putting the emphasis entirely in the wrong place. I think the old-fashioned view that central banks' privileges allow them to have an overwhelmingly great influence on total supplies of money and credit in the economy is correct. That they can do things that no ordinary banks can do. That indeed their control of reserves, the raw material, as it were, for loan creation, for credit expansion, uh, is is really the key to what the rest of the banks are up to. And I've looked at past cycles of credit, boom bust cycles, one of your
Yeah.
favorite topics.
Yes.
And I have, for historic cycles, particularly ones where the banks were said to be engaged in bank lending manias. And I've shown that if in almost every one of these incidents, the lending was supported by reserve creation, was driven by it. The banks weren't lending more just because they felt like it. They were lending more because they could, because central banks were supplying them with more reserve. In some cases, gold reserves were growing, but in any case, it was always reserves growing and not just banks lending more and more and more with a given quantity of reserves.
So I think this can all seem quite technical, but at the center of it is something that everyone in the world, in the United States, but throughout the world right now, is grappling with and thinking about, which is what causes inflation. Um, why have things gotten so expensive relative to where they were just 5 years ago? This isn't the first time we've experienced this. We've had it in the United States in the 1970s, and etc. And trying to understand what is the cause of this is a big force in our politics. And there's a lot of claims. So people like Elizabeth Warren, and to a lesser extent, although not to that much of a lesser extent, Kamala Harris, lay the blame at the feet of greedy corporations. Some folks like to say somehow that the bankers themselves somehow caused the inflation. Um, and I guess and then those of us that look to the government institutions that control the money supply, the Federal Reserve, the Bank of England, the ECB in Europe, say no, it's the government's fault. They control the money supply. The money supply determines the level of inflation. And I want to get to the Fed and the things about the Fed, but staying on this business, private money creation story for a minute, if that were true, that I could simply double entry bookkeep my way into more money, why not create an account with $1 trillion or $1 billion trillion? I'm not trying, like, what's the answer to that? Like, what's the constraint if I can create money out of thin air as an individual actor in the economy? I think I'll
Yeah.
buy Earth today. I'll buy Earth with $1 billion trillion.
Yes, it's a good question. It's a good question. And I don't think the proponents of the banks aren't intermediaries view have a good answer for it. What they will say is, well, the bank lending is limited by good lending opportunity. You know, so there might not be any loans out there that are worth it. Well, that begs the question. Uh, and I pointed this out, said when a banker says a loan isn't worth it, what the banker means is that the loan doesn't pay enough to cover the costs of making it. And those costs include the costs of funding it. Now, if there are no funding costs, which is what the banks can create all the lending power they need, if their funding costs are trivial, banks should be able to make any loan that covers their non-interest expenses, that covers their non-funding expenses. Well, there's a hell of a lot of loans that'll do that. And might not be able to buy the whole planet, but you'd be able to lend a hell of a lot more than banks actually lend if cost of funds weren't an issue.
I mean, why
So
not? Why not just issue enough money to buy all the profitable companies' stock on Earth,
yes, absolutely. You
and
wouldn't
just
even have to.
we'll get
There's
the
no reason to
dividends.
No, you're right. There's no reason to stick to lending. You can buy stuff, right? Because you're never going to have to fund it. No, it's absurd. Um, and again, it comes down to not recognizing that what are the costs of being a banker? What are the resources you need? And to assuming that you don't need many because you can print all the resources you want or write them up with the stroke of a pen. And this is just not the way the banking business works. It's it may be in many ways a relatively easy business, but it's not that easy. It's not as easy as being able to write. Now here's the thing: central banks can do this.
Yeah.
Central banks are special. Central banks create the ultimate settlement medium for their economies. So they never have to worry about owing anyone anything that they can't just create. But they are the exception. And if we lose sight, as the people I'm criticizing have, of the unique differences, the distinct differences between the power exercised by central banks and those exercised by other banks, then we start getting all kinds of things wrong. I mean, really, really wrong. Uh, Now, fortunately, most economists don't accept this pseudo profound view that banks are not intermediaries. Pseudo profound because it's actually wrong, but it sounds profound to people who don't think about it. But if you take your average central bank staff economists, they don't imagine that they're not unique. they 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 may exaggerate their own powers, but they understand that they have a capacity to influence all the credit conditions in the economy that ordinary banks don't have, and they're right. Let's give
So
central bankers credit for knowing something about central banks.
in the video I sent you from 2 weeks ago, a week and a half ago, I tried my best to explain why interest gets charged, because interest is uncomfortable. You can go back to our religious texts for usury laws and for sort of a demonization of money lenders. Much like money itself, banking has this fraught um, sort of reputation in our society. Uh, and the point I made was that interest, as I understand it, and I would love for you to expand or correct parts of this. Why charge interest? Why let money make money? And the way I tried to explain it was there's essentially three components. One is there is a value for time. So there's a value in my ability to buy something I want today at the expense of you delaying, you, the lender, delaying your ability to spend that money. So you're charging me for the privilege of using the savings. That's one piece of the interest. That's one price I'm paying for a service you're actually offering, not just some parasitic exploitation. One is there's a risk factor. So, hey, I might buy a car and crash it and not pay you back because I lost my job. And so you've got to try to assess that and charge me a bit of a premium, and almost like an insurance premium for the risk of lending me this money. That if you're a bank, you don't even have your money. You actually owe back to someone else, a depositor. And then third, which is the sort of macroeconomic factor, is, well, because we have these stupid central banks that keep printing more money and devaluing our currency, if I lend you money and you're going to pay it back to me over time, you are going to be paying it back with dollars that have lower purchasing power than at the time when I lent it. So I have to charge you enough interest to make up for the fact that the money you're paying me back is worth less money. Did I get that basically right? Is
Yep.
that a
Yes. The one I think people have the most difficulty with is the first the time value argument because it's subtle. Why is there a time value? What are you giving up when you lend something, some money to someone uh, that you need compensation for it, apart from any risks and apart from including the risk of inflation? And I think time value is correct. When you lend somebody $100, you may not necessarily have wanted to spend that $100 right away, but even if you weren't planning on it, you might change your mind. That is, you might run into a situation where, gosh, you wished you had the $100, and so uh, for that reason alone, lending money, people don't lend money for nothing except to friends now and then. The general idea is that there's no real complete substitution in the sense that not having your money in the future always is less valuable than having it today, other things equal. That's all there is to it. And the real interest rates reflect that time preference factor, as some Austrians call it. And that is just a fundamental rational fact of reality that people may not like it, but they have to understand that if people are not compensated for that time preference, then they will lend that much less or nothing at all. And
yeah, that
so
that seems to be the
you
thing.
can get rid of interest, but you can't do it without impacting the supply of funds available to be borrowed.
There is a sort of assumption in a lot of the discourse around this and around credit and capital that there's this kind that like there's this capital that just is there to be grabbed. It's sitting there, it's ready. Uh there's no one that has any other use for it. That it's this almost unlimited reserve to be drawn on, and how dare you restrict its supply, when in reality it's your grandmother's life savings, and she does have a use for it, and you have to make it worth her while to part with it.
That's right. I mean, anybody who has a pile of savings, even a small pile, has options. Consumption is one option, but there are a million ways one can invest, including buying equipment or buying shares. So uh, you're always in a situation where to coax people into making the decision to lend, you have to give them a return that is compensating them for what they're giving up. And they are giving up something, whether it's the option of being able to consume if they need to, or the return they can expect by investing in a factory or whatever. There's something else they could do that they have to be compensated for. But on the other hand, it's true that throughout history and to this day, a lot of people find interest simply mysterious or appalling or both, and imagine that it could be dispensed with. Um, and I think that they are thinking in ways that go contrary to human nature ultimately.
So now we come to the center in the United States, the Federal Reserve, the bank, the lender of last resort. So among the things I've read from you is sort of uh, the references to, is it but Badgett, and the theory of the lender of last resort. So
Mhm.
let's just start with a very simple question: what is the Federal Reserve?
Well, the Federal Reserve uh, is our central bank in the United States, and it was set up more or less to serve as a lender of last resort. There were specific circumstances behind the Fed's creation. The Federal Reserve Act was passed in 1913. There were specific circumstances that uh, led to the perception that such an institution was needed. But they fall into the broad category of lender of last resort. Uh, Actually, I have an article about this. Actually, what happened was we had laws that strictly limited or prohibited altogether existing banks' ability to issue paper currency, something that was much more important for payments back in the 19th century than it is now. State banks were altogether prohibited from issuing this stuff, and national banks, chartered by the federal government, which were first established during the Civil War, they could only issue currency if it was backed by particular government securities. Well, the government started supplying fewer and fewer of those securities by the end of the 19th century. And wouldn't you know it, we had shortages of currency occurring periodically, bad ones. So the Fed was created to make up for this occasional deficiency of currency by being able to issue currency when the other banks couldn't. It was as simple as that. It would be as if you were a perfectly healthy man who would go occasionally and get some food out of the pantry. And I came along and chopped your hands off. And then I offered my services to you as the food get grabber of last resort. Now, if I hadn't chopped your hands off, you wouldn't need a food grabber of last resort. You'd be still relying on your first resort hands to get
Yeah.
the food out of the pantry.
It's the
But
arsonist firefighter that the government has
similar, yeah,
historically been
yeah,
best at playing. It's the
that's right. We
yeah.
completely created through our own misguided laws circumstances where the banks couldn't help themselves by issuing more paper notes when they were needed. And then we proposed a new institution that the magic of which consisted of nothing else but being exempt from the prohibitions or limitations imposed on all the other banks. The Fed could issue notes based on general assets. In fact, the way the system was supposed to work, and did work for the most part at first, was a national bank with perfectly good assets that under different circumstances might have backed its own notes, but couldn't now, would go to the Fed with those assets, and the Fed would buy them and hand over Federal Reserve notes. All it was doing was making up for what the national bank was not allowed to do under the law on its own, with its own currency.
I think one of the things that's interesting to think about and remember is that today, Federal Reserve notes are the only base money. They are our currency. But when the
They
Fed
are
was,
they
right?
are our currency, but they're not the only base money, because banks' credit balances at the Fed, their deposits at the Fed, are also considered part of the monetary base,
Sure.
along
So
with a
so the
Federal
digital,
Reserve note,
the did,
the digital Federal
yeah,
Reserve notes, if you
yeah.
like, because they, at any time, they can convert those into paper currency and vice versa.
So, but the dollars, U.S. dollars, are Federal Reserve money. When
Well,
the Fed,
that's not
right?
quite right. That's not quite right either, because
Okay, help me
uh,
understand this.
by most definitions, your check account balance is US dollars too. Those are dollars. They're just private dollars. So,
Okay,
well, we
but
want to,
when but if they're converted, if I want to get them as cash,
then you would be converting them into what I do, John, is I speak of the Federal Reserve dollars and private dollars. So, and the Federal Reserve dollars, they are the basis for, or the base upon which other dollars are created.
so Mike, so the Federal Reserve dollars of today, when the Fed was created, was gold, right? Is that correct? That there was, I mean, there was a base money, there was a like the money that was. If I went to the bank in 1914,
Mm-hmm.
I could get gold with my Federal Reserve note.
Yes. Originally, Federal Reserve dollars were themselves redeemable claims to gold. And that continued to be the case until 1933, March 1933. So what you had was a situation then when the Federal Reserve dollars were claims to gold, but commercial bank deposits were claims to Federal Reserve dollars, which could be converted into gold. So you had a sort of a pyramid structure upside down with gold at the bottom of the pyramid. And then you had a layer of Federal Reserve money, and then you had the deposits of ordinary banks built on top of that.
One of the things that gets brought up a lot now um, is the question: is the Fed private or public? And when I and it's I hadn't thought about the circumstances of its creation until this conversation, really, in terms of recently. That because in modern today it feels much more like a straightforward public agency, whereas
Right.
at the time of its creation, at the way you're describing it, it was essentially like a publicly chartered kind of bank intermediary thing that does seem more like a weird hybrid. So help me understand,
Right.
is the Fed public, private, a hybrid? Where does that matter? Where does it not matter?
Well, you're quite right, John. It was more of a hybrid when it was established. You must recall that in the United States, the closest thing we got to a central bank before the Fed was the first and second banks of the United States, and they were very controversial entities. People perceived them to have too much power, particularly the central bank, which was ultimately squashed by Andrew Jackson. And that strain of American thinking that looked upon a government bank anything that smacked of being a government bank as a dangerous thing. That continued right up until the founding of the Fed. So to get the Fed through, they had to do a number of things to package it in a way that made it palatable, particularly to Democrats, because, of course, Wilson was a Democrat and he signed the bill. Yet it was Wilson's party that had done in the Second Bank of the United States. So what did they do? Well, they went out of their way to make this new Federal Reserve System look different from a monopoly government bank. And they did two things in particular. First, they gave it the appearance of being decentralized. So they were creating 12 different banks, not just one. Uh, and then they made them nominally private. They were privately owned and continued to be privately owned by the commercial banks of the regions they were established in. So these were this was the makeup that was put over the Fed to distinguish it from something like the Bank of the United States or the Bank of England. Now, the way the Fed first operated, where the banks would just go to their Federal Reserve Bank with their assets, their commercial paper or whatever, to get extra currency, also limited the extent of central control and power, especially while the gold standard was still in place, because ultimately in this system, until 33, it was the supply of gold that ultimately determined, the progress of prices and credit and all those things. And the Fed did not control that. So,
So would you say
uh,
that at that time the Fed really was not doing monetary policy the way we understand
not
it today?
That's right. Its capacity to do monetary policy as we understand it today did gradually grow during this period. It developed open market operations in the 1920s. Uh, the control of the Fed was more and more centralized in Washington, particularly by the Banking Act of 1935. So by the time of the Depression, the Federal Reserve did have a considerable, certainly short run capacity to engage in monetary policy in the modern sense of the term. Their failure to do so adequately, of course, is one of the main themes of Milton Friedman and Anna Schwartz's monetary history of the United States and their critique of the Fed at that time. Now, once the gold standard got effectively set aside, then you were really moving towards the modern system because, of course, somebody had to be controlling the total supply of money. So the Federal Reserve's powers grew, as did the tendency for power to be within the Fed to be concentrated in Washington. I should state that although the Federal Reserve banks, the 12 banks, were private, the Federal Reserve Board, reconstituted in 35 as the Board of Governors of the Federal Reserve, was strictly a government entity. And therefore, as the board became more and more influential in Fed decision making, the stockholders, by the way, had no input into the Fed's monetary policy decision making, even though nominally they are owners of the Fed. Then of course the Fed became more and more like an orthodox central bank. So to those who insist on its private nature today, I think one must reply that for all intents and purposes, this is a government agency. The banks nominally commercial banks nominally own Federal Reserve banks. They do play a role in electing the officers of those banks, but that's about it. And they receive dividends, that too. But as far as management operations are concerned, as far as the conduct of monetary policy is concerned, the Fed is a government agency, and
The
and no one should be confused about that.
the gosh, there's more to try to unpack this than we have time, given how much time we've already talked. But I want to push on a couple key places that I think are maybe highlights. So you mentioned that the gold standard that constrained the supply of money in the United States is essentially suspended in 1933. I
That's
know,
right.
and I understand the final
Instated.
link. Yeah, I understand the final link is broken in 71 as far as international redemption with gold, right?
That's correct. That's correct.
So what exactly happened in 1933? Like how what what did an American understand to be going on to their money and savings in 1933?
Basically, in 1933, Americans, first of all, they lost the right to own gold, to hold monetary gold, and they had to return any gold they'd taken out of the system to the Federal Reserve banks. The Federal Reserve banks, in turn, had to hand over all their gold to the U.S. Treasury. So the Federal Reserve banks no longer owned gold. To this day, they don't own any gold. Uh, and uh, that was the first step. So the dollar was internally inconvertible. In April, it became fully inconvertible. They suspended convertibility, though without deciding what the fate of the gold dollar relationship would be. Gold then floated for a time, a dirty float, because the Treasury was actively intervening in the gold market. Finally, in January 1934, they permanently devalued the dollar, set its official value in gold, lowered its gold value, and raised the dollar price of gold to $35 an ounce. Uh, but but Americans never regained the right to convert dollars into gold at that price. Eventually, foreign central banks were allowed uh, to, well, two things were true. The Treasury offered to buy gold at $35 an ounce. It was buying as much gold as it would be offered. So gold actually started really flowing into the country after that. Uh, but but the in the quantity of gold that the U.S. Treasury had acquired did influence the U.S. money supply. As long as the Treasury let it, it could prevent it from having an influence by sterilizing gold inflow. We don't need to talk about that, except I will
Sure.
say it was a major, its decision to do that was a major cause of the 1937 recession. Uh, well, the Bretton Woods system after World War II reestablished a kind of gold convertibility, indirect convertibility through the London gold market. And that system was only in place for a short time before it started to unravel in the 60s. And as you said, the final link between the dollar and gold was the one that was severed by Nixon in 1971. So now gold plays absolutely no role in U.S. monetary policy and determining the quantity of money or credit created in the U.S.
So I want to jump to and spend the rest of our time on this issue of inflation,
Mm.
um, and how to understand it, because it's the it does strike me that some of the criticism about the Fed being privately owned and to what extent does that further corrupt this thing probably has validity, and it's a conversation worth having. Um,
I
the
won't
sort of
say that, yeah,
maybe can we just touch on that for a little bit? To what extent, we have these government agencies. We have this concept of regulatory capture, kind of revolving door with industry.
yeah.
It's really weird to have the Federal Reserve banks be owned by the commercial banks of the region and receive dividends. That all sounds real weird. And it seems like the notion that there's no implicit stuff going on there with regard to how the Fed, Who does the Fed buy from? At what kind of favorable rates for the different assets when they do quantitative easing? There's a lot of levers, it seems like, for the Fed to be pulling shenanigans. So help me understand the right way to think about that from your
Well,
perspective.
first of all, we have to distinguish between monetary and bank regulatory policy. And the Fed has a zillion different levers it pulls when it comes to bank regulatory policy. And I think that it is valid to be concerned about industry capture in some aspects of bank regulation. Certainly, banks lobby for or against different kinds of regulation. We see that all the time, and the Fed isn't immune to this pressure uh, any more than it's immune to pressure from the executive branch or Congress sometimes. But the fact is that when it comes to monetary policy, uh, first of all, those pressures don't necessarily have anything to do with the fact that banks own the Fed, because their ownership of the Fed doesn't give them any particular clout when it comes to telling the Fed how to regulate. They don't participate at all in the regulatory decision-making process. Of course, a bank can be an owner of the Fed and lobby the Fed, but it could lobby the Fed anyway, and many do. Uh,
But you
they
can
only
understand how someone hears that and says, I'm not sure I believe that.
well, they have to
It
ask
doesn't
themselves
sound
how.
right. Like,
They
how
have
can
to
you be
ask
an owner and
themselves
exert no influence? It's weird.
that because they're not owners in the way that owners of shares in corporations are. The only decisions they have any say over that do give them some influence are those concerning the election of officials. They vote, they put in their two bits. But when it comes to and that concerns only the officers of their particular Federal Reserve Bank. But when it comes to monetary policy, then you have the officers of these 12 banks, and then you have the board of governors, who are all government appointed. And it's a very loose connection, let's say, between the powers of the commercial bank owners on one end and the monetary policy that comes out at the other. You can claim some influence, but I don't think it's particularly great. The way the Federal Reserve bureaucracy works and reaches its monetary policy decisions also involves a great deal of groupthink. And so that dilutes the influence of that you how much influence you could trace back to the owners of the Federal Reserve stock. I think we have to worry about regulatory capture all the time. I don't think that it would be easy to make the case that the Federal Reserve's monetary policy stance has much to do uh, with the plotting of the banks that own it. I really don't think so.
Okay.
Uh, that doesn't mean its monetary policy stance is good, and doesn't mean it's not influenced by politics, by interest groups and all that, but not particularly by the banks as owners of the Fed. Um, yeah. So,
So how today in our current environment does the Fed control inflation and the amount of nominal spending in the economy? And I say that, and I know that that's a technical term that most people won't fully understand. But the way I've come to understand it with your help is that, I think everyone understands the notion of inflation, which is the price of kind of everything in total going up or down. Not
right.
any particular thing, but everything in total when you add it all up.
Most things anyway.
Yeah. Yeah.
Be a
In the
lot of them.
aggregate. In the aggregate. Um, but that there's actually this, maybe one could say, more comprehensive concept of total spending in the economy, or nominal income, that is maybe even more the thing that the Fed is in control of than inflation, because inflation is also impacted by the supply of goods.
That's right. That's
So
right.
help me understand what the Fed is in control of and how it does it.
So um, let's start with inflation, with what you were just saying. Uh, Prices can generally be increasing for two different reasons, broadly, two different reasons. One is that fewer goods are being put on the market, right? Fewer are being produced, put on the market. So that's a supply side source of rising prices.
An oil
The
embargo, a breakdown in the supply chain during
embargoes,
COVID,
yeah, hurricanes, obviously, uh, uh,
crazy lockdown policy globally.
lockdown policies and epidemics. So, wars. There's a lot of things can hurt supply, and some can hurt it enough to make it show up in price indices, and can hurt it long enough to make those prices can keep going up for a while. The other cause of inflation is spending, too much spending or more spending. And there's nothing really mysterious about spending. We all do it, so we kind of know what it is from our own point of view. But what we're talking about here is the total amount of spending done by everybody, businesses included. And you can measure it. You can look it up. In fact, GDP, when it's not adjusted for inflation, is really a measure of total spending, sometimes called nominal GDP to distinguish it from the inflation adjusted real GDP. Okay. So, so those are the two sources of inflation. I think it's correct to say that for the most part in modern history, excessive growth in spending has been far more important than supply side constraints as a cause of high inflation, particularly high inflation that lasts for a while, like for many, many months or years. And uh, also any really extreme inflation, it's hard to come up with supply side scenarios that can do that all by themselves. Usually excessive money growth that finally leads to distrust of currency. So that causes people to spend even more, right? They
Right.
trying to get rid of their money fast
So
before it becomes
that's the velocity of money.
that's the velocity of money, but the velocity is a factor in total spending. Total spending is informed by the total money of supply of money people have available to spend, and how rapidly they're willing to get rid of the money that they have. Those are the two factors: money stock and money velocity. Okay, so where does central bank get into the picture? Their role is not to influence the supply of goods. They have very little to say about that, very few. They have practically no levers they can pull or push that could make the more goods available to keep prices down. But they do have the power to control the stock of money, which is one of the two factors that informs total spending. So it is by regulating the available stock of money, uh, and we can talk about how they do that, we
Mm-hmm.
want to, that central banks exert their influence, their main influence on inflation. Of course, they can also influence velocity independently of the stock of money to the extent that they say things and the public believes things that causes it to change its expectations in a way that affects how rapidly it spends money. So
Is
now,
one good
before
way to think
yeah,
about this is one good way to think about this that money is a good that we have utility for, we want to use it for things, and that we can have a supply and demand for money itself, and that the
oh,
supply and demand for money, the price that happens there as a result of it is its purchasing power. Is that a way to think about it? So if the Fed increases the supply of money, its price goes down, which is to say its purchasing power goes down.
That's correct. No,
Okay.
that's absolutely right. Uh, People have a definite demand for money that confronts the supply. The demand for money is uh, changes velocity is a factor that informs or reflects the demand for money. Right? If people, if you think about the hyperinflation, German marks are rapidly losing value. The demand for them is falling because people don't want to be stuck holding stuff that's depreciating. So they spend it as fast as they get it. And that's called a very high velocity of money. And that makes spending go up, and that makes prices go up, and that makes the value of money go down.
Got it.
So less demand, the value goes down, just like with goods. And so it's only important for people to remember that the general level of prices goes up, the purchasing power of money or the price of money goes down.
So we have this, I think people can understand, and it's like a meme, like with Jerome Powell with the printing press kind of thing, that the Fed prints money. I know I do it this because obviously a lot of times it's just creating digital accounts. It's not
That's
literally
right.
running a printing press.
Creating reserves that are digital for the banks to use.
I made a um an error that you pointed out in my explanation of the mechanics of how it's doing that today that I want to be corrected on. So what I
Yeah, yeah,
explained in my video was we hear all this talk about interest rates, but what the Fed is really doing is changing the supply of money, and that through its open market operations, and then that changes the federal funds rate
yeah.
by changing the supply of available loanable funds. So, we buy a bunch of treasuries, print more money, banks have more money to lend, interest rates go down. Um, that makes sense when I'm thinking like, oh, that's how they're increasing the supply of money. Um,
Mhm.
and you pointed out though that this, and I remembered this now after the fact, that there was a bunch of things that happened in the aftermath of the 2008 financial crisis that changed the way the Fed physically manipulates things. So talk through what the Fed now does. Help me understand that.
Okay. Well, I better review what you were describing first, in that because it's an accurate description of how things used to work. And this is before October 2008, uh, when the Fed wanted to ease monetary policy. One thing was common between that era and today. The Fed monetary stance uh, was defined as an interest rate target it aimed for. And that basically that went like this. If the Fed thought that the money supply was growing too fast, it would set a higher interest rate target. And that higher interest rate target would would imply a tightening of credit all around for the simple reason that if rates are higher, people borrow less. And that would mean less money creation. Now, how it got the target, how it achieved its desired interest rate target is what changed between before 2000, October 2008 and after. Before, if it wanted to have the interest rate target, set a higher interest rate target, uh, it would announce the target, and then, if needed to, it would engage in open market. It would adjust the amount of bonds it bought in government securities it bought in the open market. It would buy fewer because by lending less itself, the Fed made reduce the amount of reserves available to the banking system or how rapidly that amount was growing. And that would mean that the banks would have to curtail their lending and raise their interest rates. And that would mean people would borrow less. And so the money supply would not grow as rapidly.
And I want to
So,
connect that in my own thinking and for the audience to the earlier part of our conversation. When we were talking about what banks do, you talked
Yeah,
about the way they will ultimately fund the loan they make. That, okay,
that's
I
right.
borrow the $50,000 from the bank to go buy a car, and despite whatever temporary accounting nonsense might be going on, they ultimately need to pay my Toyota dealer the 50 grand, and
Yeah,
they're going to pay it in what essentially from the existing stock of reserves
that's correct.
that
That's
someone holds. So
that's right.
it's
And that
right.
stock could be increased by the Fed.
So when the Fed is controlling the base stock of reserves that the whole lending and bank system has to work with. So however it might multiply through the lending process, the money multiplier, that ratio basically moves up and down with the base of reserves the Fed has control over.
Well, the ratio might not change, but the total quantity will change, right?
Yeah.
Uh, so the multiplier needn't change. But yeah, if I'm the Fed and I buy, let's say I buy $100 million worth of Treasury securities, whoever sells me those securities is getting $100 million bank deposit, and that bank deposit is going to and be a claim to $100,000 of fresh Federal Reserve dollars. So the banking system has that much
Or
more
100
reserve.
million, you mean?
100 million.
Yeah, yeah.
Sorry, thank you. 100 million. The banking system has that many more reserves to play with to support that much more lending on its part.
And that
And
money
so
is not debt, right? That's just money. That's money that can be spent. It doesn't need to be given back. There's no sense in which the money that the Fed has paid the bank with is debt.
the Federal Reserves, the reserves that the Fed creates are not debt in the sense that it doesn't owe anything on them. The Fed, these are the ultimate dollars of the system.
Okay.
That doesn't mean that they don't show up as liabilities on the Fed's books. This gets a little confusing because usually liabilities are debts. Then this is just an accounting fiction or an accounting vestige of the old gold standard days. But the best way to think about Federal Reserve liabilities is the way that a former Federal Reserve vice president at the New York Fed described them. They're IOU nothings. So the Fed has all these outstanding IOUs, but it owes nothing on them because you can't get anything for them
Yeah, so I
except
get
some more
my
IOUs.
so I take my to get out a good old prop. If I take this $20 bill to the Fed, they can give me $21 bills in
They
return.
might, yeah.
But that's it.
If they
There's
let
no
you in,
other. It's
if
not a
they let you in,
liability.
that's right. They won't let you in, but if they did, and if you somehow talk them into doing anything with your 20, they would give you another 20 or 21s or something. Their liabilities would not change. They wouldn't be canceling or paying off their any meaningful obligations. That's
Yeah,
right.
the Fed can't go bankrupt because it prints the money. So this is not a
That's
thing.
essentially correct. That's right. So anyway, we described how in the old days the Fed would create more reserves or less, depending on whether it wanted interest rates to be higher or lower, depending on what it viewed the course of uh, prices mainly. It's concerned about unemployment as well, but our focus is on inflation. So if its only concern was keeping prices from rising faster, then it would try to raise interest rates, slow down money growth, and do it through less reserve creation.
What
Might
changed?
might might actually destroy reserves if it had to. What changed was it in 2008 the Fed got permission to start paying interest on reserves. That's one of the things that it did. And then soon thereafter, it was already creating a lot of loans from emergency lending. But it wasn't long before it was deliberately engaging in quantitative easing, buying large amounts of securities uh, while paying interest on reserves. And at this time, interest rates were near zero anyway, so it ended up paying only a modest amount on reserves. But the basic point is that the new system is one in which the Fed uh, pays interest on reserves at a rate that is above its usual monetary policy target rate. And that means that banks will pile up reserves. All the reserves that the Fed creates tend to just be held on to by the banks instead of being used to support more lending. Why? Because if the reserves pay an interest rate higher than the target rate, which is the overnight policy rate, then of course they make more money holding on to the reserves than they can make by lending them overnight.
So this
Short.
sounds like the Fed, by paying interest on money sitting in the bank's balance sheet, they sort of convert that money into gold in your pocket. Like it's not being put into the financial system to be put to use. Is that one way to think about it? It's like,
It's one way to think about it. The other way is to think about it is that the Fed is encouraging the banks to, instead of using these new resources to support lending of all different sorts, to simply invest in the Fed. So they're investing in the Fed the way they might have invested once in the gold mining industry by piling up gold, right? If you
yeah.
imagine a bank that you depositors bring gold to it and it just piles up gold and doesn't make any loans, uh, that would be the analogy.
So
Here
so
it's
that's
piling up Federal Reserve reserves.
so now there's some other piece of the puzzle though, right? Because I
The puzzle gets very complicated, but 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 essentially under this system, uh, adding reserves to the system doesn't itself affect interest rates. The banks just sit on the reserves. They don't lend, so nothing happens to interest rates. The banks already have more reserves than they could possibly need for settlement purposes and other things. So they're not they're not the marginal cost to them of lending isn't really being influenced by the availability of reserves. So under this system, without any of the other bells and whistles that exist, the tendency would be for one in which to change the stance of monetary policy instead of buying securities or selling securities, uh, which it can do, but it's not going to have any effect on lending rates. The Fed has to change that interest rate on reserves, and that's going to ripple through the system and affect. That's going to affect what the banks are willing to charge for their own loans. So in a
so
way, it's more direct. The Fed directly changes the interest rates throughout the economy short term by changing the administered rate it pays on reserves without having to actually change the available quantity of reserves.
I remember seeing a graph of the money multiplier, and we didn't really touch on this concept very much, but it's the way in which when a new dollar goes in. The way I understand the money multiplier is a new dollar goes into the banking system created by the Fed, and one bank can lend. You deposit that money at the bank will lend out some portion of it, not all of it, and that when that money is deposited in another bank, that
Yeah.
other bank can now lend a portion out, and so you end up with this temporary X factor. It doesn't go on infinitely, but it goes on to create a kind of multiplier effect. Is that a
That's right.
decent explanation of that?
That is a standard textbook explanation of how things used to work, but it's
My
actually,
understanding is that
yeah,
when interest on reserves was paid, that instantly like collapsed that multiplier.
yeah, that's right if you accept the multiplier story, but I would urge you to avoid it because it's a bit of it's an easy target for critics. The multiplier story is very oversimplified. It gives a
Gotcha.
mechanical view of bank lending that's just not the way it actually works. either in the old system or the new. It isn't. First of all, banks can fund their loans in all kinds of ways. They don't wait passively for reserves to come in before they make a loan. Often, if banks, what banks do, and this gets back to some things we said earlier, right? They have various people coming to them asking for loans, and they ask themselves, okay, what what's the cost of funding these loans? What's it going to cost me, including interest? They don't ask, do I have reserves on hand? They ask, what does it cost to fund the loan? The cost might be the cost of parting with reserves. It might be the cost of borrowing, short term from other financial institutions, in the repo market, for example. But they're going to look for the lowest cost source of funds, and then they're going to ask what the ability to pay of the prospective borrowers are. And then if the answer is that they can profit from the loan, they'll make the loan. So they might make the loan and then go borrow the money. They don't have to wait for some depositors to come and give them money. So, oh, good, we've got some more money. But that is the impression the textbook story gives. And it's
Gotcha.
very
Interesting.
easy. It's the story that the critics of the intermediary theory often criticize that story. They can easily poke holes in it and say, therefore, the intermediation story is wrong. But the intermediary story is not the textbook multiplier story. It's much more capable of being made consistent with the reality of the banking business than that textbook story is. So watch out for that. It's
Okay.
okay.
I've made that mistake myself in my own understanding, so
They'll,
that's really helpful.
yeah,
Yeah.
they'll get you on it. They'll get you on it because it's a grossly oversimplified mechanical view. It also tends to assume a fixed reserve ratio that's set by the government. That's no longer relevant. We don't have a mandatory reserve ratio in the United States at all anymore.
Hmm.
So, and we might have gotten rid of it even before interest on reserves. But at any rate, with interest on reserves, the quantity of reserves just sloshes around. This is a bit of an exaggeration, but for the most part, changing the quantity of reserves is shifting a reserve supply schedule along a flat demand schedule. It's flat until uh, uh, you reduce the supply of reserves sufficiently to have it suddenly become important again. As long as once you created enough reserves with the interest on reserves, the banks are just indifferent to a large extent to getting more. The reason why quantitative easing is notice this isn't ordinary open market operations where you didn't have to do that much. The idea behind quantitative easing is because the usual reserve creation mechanism isn't doing much, you have to resort to buying oodles of securities, vast amounts, and you buy long-term securities instead of short. And the idea, which is theoretically controversial, is that this is going to lower long-term rates, and that's going to give you an effect of reserve creation that normally you would no longer have under this new arrangement. So, so oddly enough, the reason central banks create so many reserves in recent crises is because banks have got so many reserves to begin with that they're indifferent to small increments.
I know we've been going a good long while, and there's so much further we could go. You've got a class to get to, so eh, the the complexity that you've opened up makes it hard to think about what's happening now when we hear pop Fed talk. The things we used to be able to look at um, have gotten harder to understand. The Fed's got this huge balance sheet, but then at the same time that the balance sheet is high, you've got interest rates. So, for the average person, how should somebody think about where we're headed in terms of inflation and sort of the stability of our money today? Like, should we just listen to what the Fed is saying about interest rates? Is there other things to be looking at, like that
Well,
might give us more insight into what's going on?
I'm afraid there are no shortcuts. You know, the experts themselves, let's give them the benefit of the doubt and assume that the folks on the FOMC really are trying to combat inflation. It is not at all easy for them to know how they should set interest rates for that purpose. Partly because they've got to deal with supply. Recently, they've had supply side problems to deal with. And a big question there is whether they should even try to limit inflation when it's coming from the supply side. As you know, I don't think they should in that case. But in any event, uh, determining where interest rates should go to keep proper control of inflation is very difficult. Guessing where another group of people are going to put in for that purpose is obviously just as hard or harder. So there's no easy way. This is not an area where things are very clear cut because these decisions are based on predictions about the future, and people can differ in their predictions perfectly reasonably as for where the economy is headed. I would be misrepresenting my abilities if I pretended to have some insight as to predicting when it comes to predicting the Federal Reserve's moves. Often it's not difficult to predict them because things are pretty obvious. You can tell the general direction. There's a reactive element to Fed policy even when there isn't supposed to be. So if the last reports on inflation and unemployment suggest that money's been too easy, you can expect them to tighten and vice versa. Maybe not by very much, but beyond that, it gets very tricky, very, very tricky.
So where can people turn to read who want to geek out even deeper than this deep water geek out we've just enjoyed together to learn more and to try to better understand if they really find this stuff fascinating and want to understand it more? Where can they find your writings and where else should they look?
Well, for my writings, I did a thing online called the Monetary Policy Primer. It needed a lot of work, but now we're trying to assemble a version to be published. So that might be a useful resource. Unfortunately, I can't say exactly when it'll be available. On the changes in the Fed's monetary control system that we've been talking about, I have a book that I wrote in, I think 2019, published in 2019, called Floored, which is all about the transition to the new operating system. So I can recommend that book for understanding what the Fed used to do and what it's doing now and how it matters. Um, but gosh, there's so much stuff people can look at online now. It's difficult to know exactly where to direct them, except that well, buyer beware applies. Caveat emptor.
Um,
But this stuff is mostly online now, except for some of my books.
well, George, I asked this very guest, you know, I think we call this Dad Saves America because I think being a dad is a role we play that is really important for the future of our families and the country. How do you think about your role in the American story?
My role in the American story, oh goodness, pretty modest, I'd say. um, I see my role, which I'm won't be playing that much longer, as I think boils down to this. I think the pendulum has swung ridiculously far in the direction of the belief that only government control of money can make it work well. And I've been trying to push it the other way. Um, I think with a good reason, based on my understanding of the history and the theory. I don't know if I've managed to push it much that way at all. Perhaps I've kept it from swinging even further out in what I consider the wrong direction. But I think that's been my main intellectual effort. Um, I wish I could say that it has caught on more, but it's caught on a little bit. There are people who are aware of it, and who knows, maybe it'll gain a little bit more traction someday. But that's about what I've done.
towards a freer market banking system. Hear, hear. George Selgin, thanks for being on Dad Saves America.
You're very welcome, John. Thank you for having me.